Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the sexy topic of land tax. It's a very insidious tax in that when property investors initially purchase a property, they tend to not pay very much land tax, if potentially none at all. But as the longer you hold a property, obviously as its land value appreciates, if you've bought well, then the land tax liability starts to accumulate and it starts to creep up each year. Obviously it's most costly when you're in retirement at a stage when you'd prefer to pay less tax rather than more tax. And so that's why I think it's insidious, because it really creeps up on you. Therefore, what I wanted to do in this podcast episode is really talk through land tax considerations. I'm going to go through Victoria, New South Wales and Queensland in terms of their land tax regimes. I haven't sat down and analysed the other states' land tax regimes, but depending on whether they have a flat rate or a margin rate system, you're probably going to get the similar sort of themes from Victoria and Queensland if you're in any of those other states. My key sort of message, I guess, from this podcast is think about land tax at the beginning, because once you own a property, it tends to be cost prohibitive to change that in the future down the track. And so you will have to live with that ownership structure and its consequences, and land tax could be one of those consequences for as long as you own that property. So best to think about that at the outset and get it right and plan for these sorts of things, because as I said, in retirement, your land tax bill is going to be the highest it is, and it'll eat away at that income that you might otherwise be relying upon. Okay, so let's kick it off then. Firstly, I want to talk about the fact that if we buy high land value properties, that it gives rise to higher land tax liabilities. So, of course, a property's value comprises of two elements, being the underlying land value plus the dwelling, so any improvements that are permanently located on the land. And obviously, as we know, typically land appreciates, whereas buildings depreciate over time. And that's why it makes sense that if you really want to accumulate significant wealth from investing in property, that you should invest in a property that has a high land value component. Now, whether that's a house or even apartments have an attributable land value component, but really what you want is more than 50% of the property's overall value to be represented in the case of land value. Now, of course, there are a couple of negative financial consequences of investing in a high land value component property. And the first one is that high land value properties tend to produce very low rental yields. So the rental income is lower, and that's because renters really don't care so much about the underlying land value. They're more impressed by the size and quality of the accommodation, and that's what renters will pay more for. So if you've got a house in a great area, but it's an old cottage that's a little bit run down, really valuable property, but most of its land value, renters going to look at that and go, well, why would I can just go and rent a new townhouse, for example. I'm not rewarded for the underlying land value. The second negative is it obviously attracts higher land tax liabilities, which is the reason for this podcast. But remember, we have to remind ourselves of the power of compounding capital growth, and that high land value component will more than compensate us for these negatives. It'll more than compensate us for the lower income and the higher land tax, if we buy well, of course. Before I get into the land tax regimes of the different states and the different ownership structures and the considerations and so forth, I just want to talk about using a company to own property. Now, normally in the past, I've typically recommended clients either own property in personal names or in a family trust, or even in a self-managed super fund, but rarely in a company name. And the reason for that is that the biggest disadvantage is that a company isn't entitled to a 50% capital gains tax discount. So, for example, if you earn or if you crystallise a capital gain or realise a capital gain of, say, $100 in your personal name, and you've held that asset for more than 12 months, you can discount that gain, that $100 gain, by 50%. So that means that you will pay tax on $50 rather than $100. You will pay tax at your marginal tax rate. So if you earn over $180,000, your marginal tax rate, including Medicare levy, is 47%. So 47% of $50 is $23.50. So you made $100 capital gain, you'll pay $23.50 or 23.5% in tax. That's if it's in your personal name. Whereas if you make that gain in a company, the company doesn't get the 50% tax discount, and a company's tax rate is 30%, so it will pay $30 of tax on that gain. So really, in a company, it pays a tax rate 6.5% higher than in personal name, or that really equates to nearly about 28% more tax. And we know that if we keep a property for a long period of time, that the unrealised gain is going to be significant, so the tax is therefore significant, and paying another 28% in capital gains tax really doesn't make a lot of sense. So typically, we have avoided recommending clients using a company to own property. However, because the government has reduced the corporate tax rate for some companies, it starts to become more palatable or more attractive. So if a company is regarded as what's called a base rate entity, it will pay 25%, a tax rate of 25% this financial year and onwards. A base rate entity has two attributes. Firstly, its turnover is less than $50 million, and secondly, 80% or less of its total income is passive income. That means the company has to receive at least 20% of business income, and if it does that, all the income will be taxed at 25%. Now, if you are self-employed and you're able to distribute into a corporate beneficiary, this could be an advantage for you. If you're not self-employed or you can't distribute into a corporate beneficiary, don't worry about trying to understand what I'm trying to say. It's not going to be applicable to you at this stage. But if you can do that, then your rate of your capital gains tax rate will be 25% versus 23.5% in personal name. It starts to become a lot more palatable, particularly if owning property in a company helps you save a significant amount in land tax each year. So it's just a flag here that the change in corporate tax rates over the last few years, and the final change was made on 1 July 2021, where the corporate tax rate for base rate entities dropped to 25%, which is a great outcome. Okay, let's talk about the land tax regimes then. The first point is to say that it's a state-based tax. As any sort of property regulation tends to be state-based rather than federal, which means that each state has its own rules. But typically, or almost always, I should say, your principal place of residence does not attract land tax, is land tax free. But any properties that you own in addition to your principal place of residence typically attract land tax, so such as holiday homes, investment properties, and so forth. And that's consistent amongst all the jurisdictions there. Okay, let's talk about Victoria first. So Victoria has a land tax-free threshold of $250,000. That means that you can own $250,000 of land in addition to your primary place of residence, of course, and you won't pay any tax. If you own more than $250,000, they have a marginal tax rate system, which means that the more land you own, the higher rate of tax it is. Now, it's, I think, really noteworthy to say that 250 land tax-free threshold hasn't changed since 2009, whereas the median house price has doubled since then. So unlike New South Wales, Victoria doesn't index or change the land tax 3 threshold. So in reality, land tax is actually increasing each year. In Victoria and also in all other jurisdictions as well, joint owners share one land tax 3 threshold. So that if you've got a spouse, husband and wife, for example, and they own a property jointly, they will be taxed kind of as one individual, so one land tax 3 threshold. So if they own two properties and those properties were owned separately, so husband owned one, wife owned the other, in that situation, because they've got sole ownership, they'll enjoy a land tax 3 threshold each. In Victoria, family trusts attract a higher rate of tax, and also the land tax 3 threshold is $25,000, not $250,000. So really, practically, family trusts pay land tax right from the get-go. As such, it's worthwhile, as I've shown, you'll see in my calculations, that if you're going to use a family trust to own property in Victoria, you're probably better off to put a separate property in each trust rather than have multiple properties in one trust. Companies in Victoria are taxed at the same rate as individuals. So as I mentioned at the beginning or a few minutes ago in the podcast, if you're self-employed and you can distribute into a corporate beneficiary, then owning that property in a company could be a really good result for you in terms of reducing the amount of land tax you have, but still keeping it in an entity, so out of your personal names. In the show notes and on the blog on the website, what you will find is I have financially modelled a few different scenarios and ownership structures. So 3 scenarios, a scenario where a person owns one property, 2 properties or 3 properties in Victoria. And then for each of those scenarios, I've modelled the difference between owning it in personal name or company versus trust, either one trust or multiple trusts. So if you've got some property in Victoria, going to the link in the show notes or blog on the website and having a look at those charts certainly highlights some outcomes, and some considerable outcomes in terms of future land tax liabilities. Okay, New South Wales has a much simpler system. They have just a flat rate of tax and a tax-free threshold that is indexed each year. So at the moment, for this year, the land tax-free threshold in New South Wales is $755,000, which is obviously 3 times higher than Victoria, which is nice. Any land value that's in excess of $755,000 is taxed at a flat rate of 1.6%. The land tax-free threshold of $755,000 is available to individuals, companies and self-managed super funds, but not family trusts. So that means that if you own a property in a family trust in New South Wales and that the land value of that property is in excess of $755,000, it means you will pay over $12,000 a year more in land tax because you've owned that property in a family trust, as opposed to either individually, company or self-managed super fund. So wherever possible, typically I like to avoid using a family trust in New South Wales to own direct property. And depending on situation, company or individual names is typically better. It's noteworthy to point out that New South Wales has announced it's seeking to reform property taxation, particularly stamp duty, by replacing stamp duty with an annual tax, much like a land tax. Whether that has any impact or is going to have any impact on the land tax regime in New South Wales is yet to be seen. So it'd be interesting to see how that plays out. Okay, and lastly, let's talk about Queensland's land tax regime then. So Queensland's very similar to Victoria in that it has a land tax-free threshold and then has a marginal rate system. So the more land you own, the higher the rate of tax. The land tax-free threshold in Queensland is $600,000, and I've got a link to the marginal rates, obviously, in the in the blog and the show notes. Trusts, companies and self-managed super funds, however, attract a lower rate, a lower tax-free threshold. So if you own property in a trust, company or super fund, your tax-free threshold is $350,000, and also it attracts higher rates of tax as well. Just like my calculations revealed for Victoria, if you are going to use a trust in Queensland and you plan to own multiple properties in Queensland, it is better to put one property per trust rather than have multiple properties in one trust. And again, I have undertaken the same sort of comparison and financial projections as I did for Victoria. Again, the link is in the blog and the show notes, where I've compared only 1, 2 or 3 properties, again in various ownership structures, trust versus personal name and so forth. And so you can view them on the website. As I said, the links are in the show notes. So there's a couple of other points I think are really important to mention. The first one is geographical diversification. Because land tax is a state-based tax, it's possible to benefit from the land tax-free threshold in each state. And therefore owning, say, 3 properties across 3 different states rather than 3 properties in one state will probably result in a materially lower amount of land tax liabilities over the course of ownership. Now, it's not necessarily the reason to do it alone, but of course we know that some geographical diversification in a portfolio makes a lot of sense as well, not only from investment returns perspective and investment risk, but also from a land tax perspective as well. The other thing to point out that when contemplating investment property ownership options or decisions, it's important to recognise that land tax is one of only many considerations to take into account. There's a few non-financial and financial considerations. So capital gains tax, income tax, and negative gearing benefits, that's one. Asset protection, estate planning, so the transfer of wealth. Compliance costs, so accounting fees, setup costs, those sorts of things. Trying to keep things simple. The ability to borrow and leverage property if borrowing capacity is a consideration. All these factors need to be weighed up. And of course, we can't just make decisions purely to optimize land tax outcomes. Because the reason is it's important to acknowledge that tax rules can change tomorrow. So if we go to great lengths and create a lot of complexity just merely to minimise land tax today, and then all the rules change tomorrow, then it just doesn't make sense. So it's much better. A better approach is to adopt an ownership structure that has multiple benefits, and one could include land tax. That way, if land tax gets changed, well, it's still it's still a good ownership structure, a good outcome, because you haven't just solely focused on land tax. And I would say that's true for really any taxation. Taxation is a really major consideration, but obviously there are other substantial considerations to take into account. And to wrap up, as I said at the beginning, changing the ownership structure of a property after you've purchased it, particularly some years down the track, is almost always cost prohibitive, because it can give rise to stamp duty and capital gains tax consequences, and that just makes it inefficient to change the ownership structure. So therefore, it's really important you get independent financial and taxation advice to make sure that you get the ownership structure right when you first purchase the property, so you don't have any regrets in the future. So that wraps up my podcast on land tax, a topic that's almost as enjoyable to talk about as COVID, really. But it is a bit dry, but something that we really need to think about. As I said, it can really sneak up on you and can be a really costly tax in the long run. Thanks, guys. I hope you're enjoying the podcast. If you do, please share it, leave a rating, subscribe, whatever you need to do. Greatly appreciated. Until next week, bye for now.